all questions. There's no waiting to the end this time. We got questions, questions, questions. And with that, I wanted to welcome Alex Morsink from Equivesto. How you doing, Alex?
I'm doing great, Craig. Thanks for having me.
So before we get into the Ask Me Anything about Canadian Equity Crowdfunding, and I specifically said Canadian because we're online now. We get people from all over the world sometimes jumping on, and the rules are different everywhere. So I wanted to specify that, but I also wanted you to tell us a little bit about what you do at Equivesto.
Yeah, so I'm the managing director at Equivesto and a co-founder. I'm more of the sort of finance side. My other co-founder, he's more of the tech side. So we made a fintech. That's a funny joke. Yeah, but I'm also a dealing representative. So part of what I do in running the company is really focusing on getting the companies prepared, preparing their campaign, getting them listed, and then also helping investors, sign up, go through the background checks and everything, get approved, and then setting the right kind of investment limits for them. So kind of everything.
Right. Yeah, everything. That's amazing. And we've got lots of questions here. And I see we have couple questions in the chat room already. I'm going to ask them when they fit into our question category logically. But let's start up. If I'm a startup and I'm looking to raise money, how much can I realistically raise with equity crowdfunding?
Yeah, so that's a great question because technically, we're talking about equity crowdfunding in sort of a more colloquial, common term, but equity crowdfunding actually could refer to a few different things from a legal sort of securities law perspective. So if you look at it from a securities law perspective, there's a few different types of rules that someone could use to raise capital that might constitute sort of equity crowdfunding. And essentially with the rules, the more money you want to raise, the sort of more reporting, the more preparation work needs to go into that raise. So the simplest rule, the rule that's the most popular on our platform is called the startup crowdfunding rule. And with that, companies can raise up to $500,000 per calendar year in two $250,000 campaigns or more, but typically they do two $250,000 campaigns, and those can be done back to back. So if you wanted to raise sort of $500,000 in one go, you would do a $250,000 campaign and then another $250,000 campaign. So the sort of easiest rule set lets you raise up to $500,000. There's other rules that are slightly more complicated. And so on our platform, we help companies raise up to 1.5 million typically through equity crowdfunding. But yeah, there is a range there for sure.
And the flip side of that is how much does it cost to do an equity crowdfunding round or campaign?
That's a really great question, Craig. There's a few different pieces that kind of all go into it. The first is, of course, the platform fees. So sort of what we charge as a platform to sort of facilitate that raise for you. You're also probably going to have some marketing expenses, some legal expenses, and potentially if you're doing a much higher raise and you need accountant prepared financial statements, you might also have some accounting expenses. So for us, we have an upfront application fee of $2,500 Canadian, and then we take 7% of the total raise. Marketing, if you think about the amount of marketing effort that goes into it, if you already have a massive list of people who are sort of excited to invest in you and you don't need to sort of go out and sort of reconnect with your community, your marketing expense will be much lower. But if you look at something like Kickstarter, even with millions of people on that platform, to have a successful raise, the kind of rule of thumb is about 20% of your target raise amount should be spent on marketing. That's a combination of the actual ads themselves, but also on dollars spent on the marketing firm. We, hopefully it's lower for equity crowdfunding, but you do want to make sure you have some adequate funds put aside for that. From the legal side, we provide a lot of free support. We are not your lawyer. You definitely need to work with your own lawyer, but we have free legal templates available on our website. If you're looking for something simple and you use those, potentially you would only need probably between $1,000 and $2,000 of legal time to prepare for a crowdfunding. But if you're looking for a much more complicated structure of the deal, you're looking to sort of rewrite your own custom documents, then of course the cost can go up considerably from that.
Great. That great information. And we're going to throw in the first question from the audience here. What sort of structure is the funding done in? Is it a safe, a convertible note, something else?
Yeah, that's a great question. So with equity crowdfunding, there's a variety of different securities that are eligible for companies to use to raise under equity crowdfunding. Typically, with equity crowdfunding, it does need to be something that converts or is a common share or a preferred share. You can do equity crowdfunding with something like a convertible note, because that would convert into a common or a preferred share. You can also equity crowdfund debt, but that's a sort of different kind of structure. So typically it is a common share or a preferred share. Most companies don't end up doing a convertible note, but legally would for sure be possible. We often see companies actually doing non-voting common shares because with so many smaller shareholders, giving them a vote, you would rather keep things a little bit simpler and keep the voting rights with the existing sort of leadership of the company. Regarding the safe question, typically with a safe, that's raising for a future valuation, and working with equity crowdfunding, that is a price round, and that will act as the actual valuation moment, the moment of valuation. And so a safe would actually convert when an equity crowdfunding round took place. Also in the Canadian space, I'm not sure if it's changing all of a sudden, Craig, but from my perspective, most Canadian investors are not as comfortable using safes. I know safes are very popular in the US, but most Canadian investors move away from them. Part of the challenge with it is while it makes it easier for the company to raise money in the short term, especially if you're from Silicon Valley and you're about to go and do a price round in a couple of months, if there's a little bit of a slower time, like a bit of a longer, time period, and it's not as fast between each round, there is risk for the investor because the safe isn't equity and it's also not debt. It's just an agreement to purchase equity. And so if that price round never happens or is delayed or something else takes place, there's no protection or anything of any kind for the security holder. Well, they're not even a security holder. They're holding some sort of convertible vehicle, but it's not even counted as equity. So a lot of Canadian investors that I've spoken to kind of shy away from using a safe. So if you were to work with Equivesto, we would not we would recommend against using a safe on our platform.
Yeah, I've talked to a lot of investors, and the general rule of thumb is from a VC angel investor, safes aren't safe. And they're more popular in the US, but even US investors say the same thing. They were popularized kind of like by the YC accelerator world, where they want to invest in a whole cohort versus an individual, and they take the risks there. And outside of that, not too many people want to take those risks.
Yeah, it's people I think are drawn to it because they want to avoid trying to price around so early, especially if you're doing a very close kind of like family and friends and you're raising from your uncle and you're at the pure idea stage and you don't know how to value your business. To complete an equity crowdfunding round, one of the minimum requirements is to have an MVP, to have some sort of traction, to have community support, all those kind of things. So there's definitely enough to value the company. And some companies that we've worked with have considered and have used equity crowdfunding as a vehicle to sort of convert those safes and to lock in a sort of valuation for the business. And that's part of the service we offer, is support on the valuation side.
So you mentioned, common shares. What other different types of shares can be issued by the startup?
Yeah. So as long as it's what's called like an eligible security, so it's a sort of standardized-ish security, you can offer a variety of things. So you could do voting common shares, you could do non-voting common shares, you could do non-voting preferred shares. I'm not sure why you would have voting preferred shares, but you could also offer those. You could do a convertible note. We have a company raising right now that's doing a preferred share, non-voting, but they have a dividend, a guaranteed dividend sort of tied into that, with a 3-year buyback and a conversion, an optional conversion to common shares. So you can definitely have a bit more of an interesting structure if you think your audience of investor is something that's interested in that. If you're going out for a larger group but of accredited investors or something like that, then having a little bit more of a sophisticated security does make sense. Like in this scenario, having a preferred share with a dividend and a buyback, that's kind of structuring it a little bit like a sort of debt vehicle, and that's giving a lot more liquidity to the investor, and that sort of fits with the business type. On the other hand, if you're very sort of public focused and some of the investors you'll be trying to bring in are very much what we would call retail investors, so members of the general public, they're not ultra sophisticated. Having a very sort of simple share class is sometimes easier for you and for them sort of in the structuring. And so we'll often see companies just sort of bringing in their community use a non-voting common share, potentially with a sort of built into it a kind of trust agreement. So the CEO would act as the trustee sort of the voting rights of that class of shareholders. But typically we would just do non-voting common shares, keeps it simple. They're coming in kind of at the same common level as the founders. They're sort of supporting the founders. They're in at that same stage, and they would get paid out at the same time as the founders, but they wouldn't have voting rights. So they're not sort of, you don't have a situation at a shareholders meeting where you have a couple people with like tiny, not really much voting control, but you need to find a way to sort of facilitate those votes and try to collect them and everything that can make it a bit of a mess.
And we have another question here, which lines up with my next question, what is the difference between preferred and common shares for an investor?
Yeah, so that's a great question. I keep saying everything's a great question because they're all great questions, but there is a serious difference between the two of them, but there's a lot of flexibility when it comes to actually the way you create and structure a share. So I'm going to sort of talk about them generally, but technically you could sort of customize through altering your articles of incorporation. You can create a share class that does kind of whatever you want, but the core base of it is a preferred share is before, let's say the company, is being shut down and being sold. The value of the preferred shares would be paid out before the common shares. So preferred shareholders would rank higher than common shareholders in terms of rights to the assets of the company. That's kind of a little bit complicated, but in a more basic description, preferred shares typically do not have voting rights, but typically have a dividend tied to them. Where a common share would typically, though not necessarily with equity crowdfunding, have voting rights, but would not have a guaranteed dividend, and would come later in terms of the rights on any of the assets of the company upon dilution.
Great. I think you answered that fantastic. So who determines the company's value and how does it determine?
Yeah, so that's an important part of the discussion when a company is coming to raise with the platform. So the final say on the valuation always is with the company, but we as the platform sort of withhold the right to approve or deny a company raising on the platform. If they're coming out and they're saying, we've just got an idea, but we think it's worth $30 million, we're going to say no, because we don't think that, that is a correct representation of the business, and that's fair for the investors. So we also need to protect them as well as you. Part of the way we operate is you can think of it as a sort of friendly third party who assists with the valuation. Sometimes founders don't realize that there is some risk to having too high of a valuation. Potentially if you raise with a really high valuation and then you can't fulfill some of the goals that you set out and you need to raise again, you can be forced to have what's called a down round. So you would raise at a lower valuation, and that can be really negative. And so we don't want to have that, but also it's not the same as setting a valuation with a venture capital firm. In those situations, it's a zero-sum game. So the lower your valuation, the more ownership the VC firm would get and potentially the more control. With equity crowdfunding as the platform, we're hoping to sort of help guide you to a valuation that's sort of somewhere in the middle that makes sense for you and your business. But the final say on the valuation always rests with the company, of course. You're muted there, Craig.
Yeah, thank you. As a startup, as an investor, when can I sell shares purchased via equity crowdfunding, and how does that work?
Yeah, so one of the Equity crowdfunding investments are high risk. And one of the things that make those higher risks is what's called the lack of liquidity. So basically, that means that you can't really sell the shares. You're investing in private companies, and one thing that separates private companies from public companies is because they're not listed on a stock market, you can't just turn around and sell those shares to another investor. So when you're investing in a private company, there are restrictions on your ability to sell the shares, and potentially you could never sell those shares. If you wanted to sell the shares, the time would come if that company ever did go public. There's three ways that investors can sort of get their returns from their investments. The first one is, as I mentioned, the company would go public, list on a stock market, and then you would be able to sell your shares that way. Another would be the company itself gets bought by another company, and then all the existing shares would be sold from the existing investors to this new company, hopefully at a higher price than you purchased the shares at, and then your shares would be sold as part of that deal. The third way you could get return would be if the company decides to begin issuing dividends to all of its investors. And so there they would take, some of the annual profit from the business and pay that money out to the investors, all the investors based on the number of shares. It would be an even sort of dividend per share. And so based on the number of shares you'd get more or less of a dividend. The final option, which we don't really sort of go into a lot of detail on our website, would be actually if the company offered a buyback. So that would be a situation where the company in the future offers to the investors to purchase the shares back from them, potentially at a higher price than they were initially bought by the investors. That's another option for liquidity.
So when we're talking about shares and investing, what are tag along and drag along rights, and why do we care?
Yeah. So tag along and drag along rights are actually there to protect minority shareholders, smaller shareholders. And having those on the rights of the shares that you're buying is actually quite important. Drag along rights kind of actually makes it easier for the company to sort of operate with minority shareholders, but the tag along rights is the ones that are really there sort of protecting the minority shareholders. Both drag along and tag along rights are referring to decision-making process done by the company with regards to the sale of the company's shares. The drag along rights essentially says, okay, the CEO and the board of the company, let's say they've made a decision to sell the shares to another company that's looking to buy them. With the drag along rights, the board of directors can, if the majority of shareholders vote to support the sale, they can force the smaller shareholders to sell their shares along with them. The tag along rights sort of does the opposite. So if the board is saying, oh, we're going to sell a large majority of the shares, but not all of them, the tag along rights basically says, okay, these minority shareholders have the right to also sell at the same ratio some of their shares. So it stops situations like a CEO, let's say a CEO has 75% of the shares themselves. Another company comes into the CEO and says, hey, we'd like to buy your company from you. It stops the CEO from doing something like saying, you know what, don't buy 100% of the company, just privately buy all of my shares from me and leave all of the other investors in the company. You'll still have control. You can do whatever you want, but all these investors are sort of stuck and captive. Tag along rights stops that from happening. It forces all the shares to get sold together. So it's very important for that to be there. Obviously, we're not going to allow any issuer and CEO onto the platform where we think they would do anything like that. But it's important to have those rights in place to protect those minority shareholders. And with Equivesto, we basically ensure that every company that raises on the platform has tag along and drag along rights in some form to protect investors. You're muted, Craig.
Yeah, sorry. I'm going to jump right to some of the questions here that we got. They're about your fees. So is the 2.5K upfront fee you mentioned regardless of success?
Yeah. So part of what we have to do and what's required by the platform in order for the company to even launch their campaign is essentially to run full due diligence. And that's to protect both the company and to protect the smaller investors. So we have to do full background criminal checks. We have to go through and review all the legal documentation. We do all kinds of work upfront to sort of verify and review the company before it can even list on the platform. And that costs us much more than $2,500. And so we charge the $2,500 upfront to try to offset some of that cost, and also to make sure that people are serious. It's a serious undertaking to do an equity crowdfunding campaign. And if there weren't fees upfront, potentially there would be companies who would have us do all that work, prepare the valuation and everything, but not actually go through and raise the funds. So the $2,500 fee upfront is regardless of success. And we've never had a company that's sort of we've approved and then we've taken the fee from them and then we haven't approved them to raise. The only time that would happen is if we were, as through the due diligence, there was some sort of illegal activity that was discovered. That would be the only situation where we would take that fee and then deny the company the ability to raise on the platform.
Does Equivesto do most of the marketing to my campaign? This was says, or do we need to do most of it?
Yeah. Again, that's a good and a very important question. So Equivesto, as a sort of third-party platform, we treat all of the campaigns equally. We do provide some support on the marketing side. We provide sort of educational materials and sort of descriptions and discussions of what the right kind of marketing strategy is, what companies need to do to raise and everything. We do have several thousand investors on the platform, but there is no guarantee that those investors would invest in your deal. So you should assume that you need to attract the vast majority of the investors through your own community and notifying them and sort of outreach. In terms of additional assistance on the marketing side, once companies pass 10% of their funding goal, we also will notify and publish on our own social media and things about that company's success, and we'll connect companies to members of the community that we know to potentially give them some additional exposure. We also will feature companies on the platform in our newsletter that goes out to several thousand people who are sort of signed up as investors and interested in watching, what deals are coming up on the platform. So we do some, connecting of our community to your offering and sort of the notifying that way. But I would say the vast majority of that does need to come from the company side. You're muted again.
Yeah, I know. Sorry. When I type, my mic is so close to that. And that's typical of almost like Indiegogo, Kickstarter, whatnot, when they're talking about the marketing. We've had Kirsten Ross and several other people. You've got to do that campaign and that work. And that's only after does the effect help for the platform. Everyone else gets on board and so, this looks successful. There's excitement around it. So as a startup raising money, it sounds complex dealing with all these shares, especially early stage. How do I deal with that?
Yeah. So it's definitely different. If you're used to dealing with just a smaller number of shares and everything, it can sound more complicated to suddenly have so many more shares and so many more investors and everything. Typically with the structuring, what we recommend is the creation of a new share class, specifically a non-voting share class. So in that situation, certainly on your cap table and the way things represent to other investors, you've kind of grouped all of these investors into one location. You haven't made additional vehicles or legal structures, which can sometimes overcomplicate it, but is an option as well. But in this scenario, you've grouped all the investors into one share class, and they all are what we would recommend is non-voting shares. So that's a little bit easier on the cap table side. We would also recommend having frequent updates to your investors. They have invested because they care about your business, but they also want to know sort of what's going on and what you're up to. So we highly recommend that companies have updates every quarter to sort of keep their investors engaged. don't forget, you have thousands or hundreds of people who have just invested in your business and really care about its success and helping you move forward. This is a resource and a tool that you can make use of. If you have little asks or something like that, let them know in the update and say, hey, we're looking for more customers that kind of look like this, refer a friend, or we're looking for something like that. And you can use almost this group of evangelists or believers to help expand people's brand awareness of your business and help it grow more successfully. So there is more work that goes into it because you do have more investors and more shareholders that you need to manage. But with the right sort of planning, it can definitely be less challenging than you think to manage, and it can be a really useful tool for you.
There's another question here. Some companies provide side benefits, as in perks, discounts, etc., to investing in their company. Is that required or even recommended?
So it's not required at all. It is something that can be beneficial, certainly as part of your marketing and your efforts to bring in the investors. With the offering from a legal and a securities perspective, we as a company, as the dealer brokering this, we're required to sort of verify everything that you're saying and that you're offering with regards to the securities offer. But offering a perk is something sort of outside that. So we don't monitor that perk, and the regulators are not going to sort of be chasing you down to say, oh, you promised a 10% discount for people if they invested, and this one person didn't get their discount. You don't have to worry about that piece. And so a lot of companies will consider using perks to incentivize further investing, but it's not required. It's really about you knowing your community and what they're kind of looking for. And we're willing to work with you to find the right balance for that.
So if I'm going to invest in equity crowdfunding and invest in a startup, are there better investments for tax purposes?
Yeah. So, we are not tax professionals. This is not legal tax advice or anything like that. And we would definitely recommend that anyone considering investing speak to their own, accountant or tax professional about the tax implications. But there are some investments that you can invest in through equity crowdfunding that are actually TFSA RRSP eligible. So in that scenario, you'd be able to create a TFSA or RSP account and actually invest in that business from that account. We work with a third-party trust company called Western Pacific Trust to help make that possible. So essentially, you could do that basically one of two ways. Either you can make the investment like normal on the platform and let us know that you'd like it to be TFSA or RSP. You'd put it in a TFSA or RSP. And then after you've made the investment, you'd create the account with Western Pacific Trust and then essentially move that investment with an in-kind contribution into your TFSA or RSP. The other option would be to reach out to us, let us know that you'd like to invest from a TFSA or RSP, but like to do it first. Then we would connect you with Western Pacific Trust. You could create your new TFSA or RSP there, and then you could either move funds from an existing TFSA or RSP, or you could add a new contribution to that account and then make the investment from that account, still using the platform. One thing to note, though, with opening an account with Western Pacific Trust, which is necessary to be investing on the platform in a TFSA or RSP eligible manner, you will have some account fees related to that account. So if you're only making one investment and it's a small investment, investing through a TFSA or RSP probably doesn't make sense. However, if you're planning on making multiple investments and holding them all in that TFSA or RSP, or you're making a very large investment, then potentially putting it in a TFSA or RSP would make sense.
Now, you mentioned dividends earlier. Can I get dividends from shares I buy through equity crowdfunding?
You certainly can. And so that can be a really interesting option. A lot of the companies raising through equity crowdfunding are sort of that longer shot, long-term time horizon where, okay, I'm investing something that's high risk and maybe it's going to pay off in 5 or 7 years or something, but I'm basically, taking a chance on this business. Some companies, and we do have an offering now that does offer this, are offering dividends upfront. So dividends are being paid every quarter, essentially immediately as soon as the campaign closes. And so in that situation, you can still access a higher risk investment with potential for greater returns, but also have a little bit more liquidity involved as well. And especially if you hold that in a TFSA or RSP, that can be a very attractive combination.
It sounds like a very attractive combination. Was Equivesto funded through crowdfunding? Another question from just out of curiosity.
That's a great question, chat. So sadly, equity crowdfunding, we needed capital to create the platform. And because the platform didn't exist, we couldn't use the platform. There's a bit of a chicken and egg scenario there with regards to the creation of the platform. And so no, equity crowdfunding wasn't funded through Equivesto, wasn't funded through equity crowdfunding, sadly, but we might open up the platform to our community to invest in it in the future. How did it get started? I saw your question was, what's the founding story? So myself and my co-founder, we're both working in more of a sort of corporate scenario, and we had some friends that had started business previously and hadn't really been able to get access to the capital that they were looking for, or getting the capital had been a real struggle. There was also some, challenges with, I think, unconscious bias and things in there where, I obviously look the way that I do, and that's a privilege in a lot of scenarios. And so a lot of people didn't have access to that same level of privilege, and that would preclude them from getting funding. Also, on the flip side, we had friends of ours as well, and ourselves included, who were looking to invest in startups, but that wasn't an option either, because at the time you had to be a millionaire to invest in startups. And so we sort of saw this market problem from both sides and thought that could be a great idea for a business. To get started and everything with equity crowdfunding, you have to be licensed as something that's called an exempt market dealer. And it's very expensive and takes a long time to get that license. We started working on the business in early 2017, and we got that license in the summer of 2020. And so it costs us many hundreds of thousands and many, many hours of work to sort of build the technology, build the platform, and get that license. And so we did have to raise capital before the platform existed. And so we had to go the more traditional route, raising from angels. But we definitely see the value, of course, of equity crowdfunding. And we think it'd be great to have Equivesto potentially raise on our own platform sometime in the future.
Yeah, and if you want to hear more about the founding interview, I'm going to be having a nice interview with you, I think, on May 19th.
Yeah, I'm not sure the date either.
I got it penciled in. I haven't posted it yet, but we've agreed to the date. So stay tuned. It'll be in the newsletter. It'll be coming up. We got another question from the chat room. When signing up for Equivesto account, you ask for marital status, but you only provide married and divorced. What about separated or common law?
Oh, I honestly thought we provided those options. I'll have to have a look. We definitely, there's many options beyond just married and divorced. So potentially that was a technology glitch, because I know certainly we have, common law, single, a few other options like that. So I'm sorry about that. Whoever asked the question, please reach out to me directly, and I'll get that sorted for you right away.
Great. Thanks. Great technical support here. We solve problems. You got problems with Equivesto platform, just let us know. How do I, as an investor, how do I keep track with the company's progress or value once I've invested?
Yeah. So while we're hoping to expand our relationship between the platform and the companies in the future, right now, after you do invest as an investor, your relationship is directly with the company. And so that's when the company should be providing updates directly to you, the investor, on whatever basis. When you are investing, in the documentation and on the campaign page, the company should outline sort of their plans around how frequently they'll be giving updates to investors and what that should look like. Typically, as I mentioned earlier, we recommend that on a quarterly basis. So look in the offering document to see exactly what the sort of company outlines in terms of that. But we recommend that they do that on a quarterly basis. So you should get an email saying, hey, thank you very much for your investment. This is kind of, where we are and what the next step is. From a legal basis, they should at least update you at least once a year, and give you an update from that perspective. That's required by the government.
Does equity crowdfunding preclude getting VC or angel investment? Meaning, if I equity crowdfund, does that mean angel or VCs won't talk to me?
No, that was something that people were worried about initially when equity crowdfunding first started, especially with, there's going to be more people on the cap table. People aren't going to like that kind of thing. We've definitely seen that not being the case as much in the UK and in the US, which are a little bit more advanced in the sort of market than Canada is. We see a lot of follow-on investment from angels, venture capitalists, and private equity funds after equity crowdfunding has happened. And the same thing is really starting to happen here in Canada. We also have relationships with different venture capital firms ourselves at Equivesto. So if you run around with us and it's successful and everything, and then in the future you're looking to sort of do another round and it's beyond what we can offer, we'd be happy to make an introduction to different venture capital firms that might fit your company, and also who would be happy to work with you, even though you did an equity crowdfunding round. I think a lot of the concerns around, if you've equity crowdfunded, VCs don't want to come in. Those are not really necessarily playing out in reality with a lot of the VCs that we talk to.
How long does an equity crowdfunding campaign typically run for? How long does it take?
Yeah, so the legal maximum that a crowdfunding campaign can run for is 90 days. Typically, we see them running about 45 days. A month is a little bit too short. 45 days gives you sort of enough time to sort of have a launch, have the middle of the campaign, and then have a closing. But it gives you lots of time at the end where if you're seeing a ton of interest and engagement from your community, you can extend it. You can move it, you can add an additional 15 days on there or something. And it gives you a little bit more flexibility on that side. But if you raise everything in that first 45 days and you've hit all your targets, then, you can close and get the funding a bit sooner.
So the next question is how long, you said funding a little bit sooner, how long from start or when I start contacting you till the funds are available to the startup? And how does that compare to the VC and angel investor process from the start of talking to them, due diligence, and getting a check?
Yeah. So I'll start with sort of the traditional model first. So typically with an angel or a VC, there's usually about 6 months between introduction. You pitch them a couple of times, they show their interest. Maybe they give you a letter of intent, and then you start the due diligence. You go through the due diligence, and then you finally get that check in your bank account. That's usually about 6 months. With angels, sometimes it can be a little bit shorter, and then sometimes with VCs, it can be even longer. Some VCs, the old rule of thumb was 9 months, 9 meetings. It's gotten a little bit shorter with COVID because everyone's doing the virtual meetings. But yeah, it's still a pretty long period of time. It's not quick once you get that, term sheet or the letter of intent. That's when it really can take a lot longer and drag out. With equity crowdfunding, we try to keep it shorter than that. Assuming you run a 45-day campaign, essentially the company would reach out to us. We would determine they're a fit, and they would apply. There's then a sort of 2-week due diligence period that we do with them. During that time, if they're working with a marketing firm, then they would start, doing the marketing preparations on that side as well. Typically, we encourage them to do 1 month at least of pre-campaign marketing. It's quite important to sort of engage your community, to communicate with them and get them kind of ready for the raise when it's going to start, as opposed to launching the campaign and then starting the marketing. But let's assume your community's all ready already and everybody's ready to go. It'll be 2 weeks of pre-campaign sort of due diligence, and then potentially another 4 weeks or so of structuring and planning. But that could be as short as 2 weeks. and then you launch the campaign. The campaign runs for as long as you want, as short as 30 days, as long as 90, usually about 45. And then there's the closing period after the campaign, which takes about 30 days as well. And that's sort of preparing all the documents, reviewing them, sending them back and forth between us and your lawyer, and then finally having your lawyer officially do the filing with the regulator at the end, and then we give you the funds. So if you kind of add that all together, it's, between 2 and 4 months for equity crowdfunding, depending on, how much preparation work you do before you speak to us.
People are always concerned with money early on. Can you kind of give us a high level what the cost difference is, say, working with VCs or angels versus raising with equity crowdfunding?
Yeah. So one thing that I didn't realize when I went out to, because we did raise for Equivesto from angels to sort of build the platform. One thing I didn't realize is what's typical in the space, which is that, when you're doing your VC or angel round, you're paying lawyers and they're paying lawyers to sort of negotiate the whole terms of the deal, sort of back and forth over a 1 or 2 month period. You can rack up between $30,000 to $50,000 in legal fees, from a combination of your lawyer and the VC's lawyer. And the expectation is that the startup pays for the legal fees from both sides with the funds they get from the raise. So let's say you're raising 100,000 and you spent, 15,000 on legal, they spent 15,000 on legal. You have to pay that $30,000 tab. So at the end of the day, you might end up with $70,000, even though you thought you're raising 100. With equity crowdfunding, yeah, there's a bunch of different areas where there are fees. We talked about them a little bit, but there's the application fee and the success fee of 7% from Equivesto. There's also potentially some marketing fees and some legal fees as well. But we try to help minimize those fees as much as we can. We have different firms that we have relationships with, both lawyers and different equity crowdfunding marketing specialist agencies who have different or sort of preferred pricing for our customers. So we're hoping to help minimize those fees for you as much as possible. Certainly less than the 30 to 50,000 that you would typically spend on legal. But marketing can be expensive if you don't have, a strong community built already. To build that community can be more expensive. As we talked about, it's probably around 20% of the targeted raise amount is the rule of thumb for Kickstarter. We try to keep that more between sort of 10 to 15% for equity crowdfunding, but that really does depend on the size of your community and which marketing firm you're working with there.
Now, how much work is an equity crowdfunding campaign?
I would love to get on and say it's super easy and you just click 3 buttons and magically, hundreds of thousands of dollars appear in your company's bank account, but that wouldn't be the reality. It is serious work and it takes time and it takes planning. We do as much as we can to try to make that easier for you and make the process as nice and as smooth as possible. But it's not something that, you just sort of decide that you want to do and not really put time or focus into. It's something that does take time and effort from the company raising, as well as us, the platform managing it, and any other supporting groups that are involved. So it does take some serious work.
What types of success have you seen with companies raising on your platform?
Yeah, we launched the platform essentially at the beginning of September of 2020. And we've had 4 or 5 campaigns close successfully. And we have 3 campaigns live right now that, I expect them to all end successfully as well. And so we've really seen a lot of success. We've only, including these 3 live right now, we've only run 10 campaigns in total. And so that'll end up being a 70% success rate. Part of what we discovered, to be honest, early on is some key learnings about, how equity crowdfunding works and how we need to sort of work with companies to make sure they're successful. So since we essentially made those changes internally with, how we deal with companies and sort of the things we get you to do before you're raised, every company that's raised on our platform has been successful since then. And we're seeing some campaigns get, 200, 300% above their minimum raise goal. So we're definitely seeing some very successful raises for companies, which is fantastic.
Yeah, it's great. Are there types of companies that work better for equity crowdfunding?
There certainly are. Equity crowdfunding is going out to a broader community, your broader community and extended community, and inviting them to invest in your business. So if your business is easily understood by the general public, if it's a product that the general public could buy or a service, something that's a bit more accessible, that's easier to explain to them, you're going to be in a better position to have a successful raise. Also, if you already have traction, if you already have interest, if you already have a community engaging with your business as well, that's going to put you in a position to have a very successful raise. We've had, it is not just about startups, right? We've had restaurants like, small businesses like restaurants on the platform, which have raised successfully. But we've also had sort of high-tech startups in esports space. We've had more traditional investments like literally a gold mine on the platform. We've got, real estate right now, neobank, e-commerce platform. There's quite a range of different kinds of companies that can be successful. Companies that wouldn't be successful would be companies where the value of the business itself is really closely tied to the employees. So a consulting company, for example, where the value of your company is just in the consultants that are your employees, that type of business wouldn't work as well for equity crowdfunding because let's say, you as the founder and your whole consulting team were to quit the business, suddenly the business would have no value. And so those investors coming in wouldn't be in a strong position. So having a business with a strong, community connection and something that's sort of retail or general consumer facing is a strong marker for success.
Yeah, we get another question here, and I'm gonna make it a little bit. They say, can only investors from Canada invest, or is it global? Can talk about the geography a bit?
Yeah. So with equity crowdfunding, so with regular crowdfunding, like a rewards-based crowdfunding, like Kickstarter or something like that, anyone can go in. With equity crowdfunding, you're offering securities, ownership of your company for sale, and there's a pile more regulation than just pre-selling a shirt or a watch or whatever it is on Kickstarter. Because of that, there are some serious restrictions around who can participate. And the platform that's facilitating your round and brokering the deal, part of our job is also to verify the identity of the investors, run background and criminal checks on them, and to actually work with them like a financial advisor would work with you at a bank. We need to make sure that even if they're only investing $100, they understand the risks, they're signing the right forms, and that this investment sort of makes sense for them. That's a legal requirement. And so we can only support investors from locations that we, the platform, are licensed. So Equivesto is licensed in Ontario, BC, Alberta, and Nova Scotia. Right now, we're hoping to add the rest of Canada by the end of this year. But in that situation, we can only allow investors in from literally those 4 provinces. In Canada, there's a different securities regulator for every province, while in the rest of the world, there's usually one regulator for the whole country. So that makes it a little bit more challenging for us to scale and add more provinces, but we are doing that. In terms of global or from any other countries, no, we would be required to be licensed in every country that you would want to take investors from. And that would also add a lot of complication for you with how you're structuring and managing your business. Technically, there are requirements that you need to meet as a company just taking investment from people outside of Canada. Most people don't realize that and just kind of, they're small companies raising money and the regulator never really notices. I'm not a legal expert on that, so I can't really opine. I just know from our experience that we can only assist raising from investors in provinces where we are licensed. So if you wanted to raise from US investors, for example, you would need to work with a US equity crowdfunding platform to access those investors.
Perfect. So we're almost out of time, but I got one question here, and I'm not asking for investor advice here. But as an investor, what type of information is available on the companies to help me decide which ones I could, or I might want to invest in?
Yeah, there's a lot of information that's available. So of course, there's the campaign page, which is where that's where you kind of start. There's a whole outline of the details of their campaign, what they want to use the funds for, how much they're raising, the structure of the deal, everything like that is on the campaign page itself. They'll probably also have a pitch video and some other images and stuff there. There'll also be attached to that probably a pitch deck, which will provide more information, potentially financials, either existing financials or financial projections, but that's not required. So you can review those. There's also going to be a shareholders agreement or amendment to the articles of incorporation, some other legal documents for you to understand exactly, okay, what am I buying? What are the terms that I'm agreeing to and all that sort of stuff. The most important document that I would highly recommend that every investor review and look at is called the offering document. And we've done a run through in a webinar previously, Craig, about exactly what goes into that document. But essentially, the offering document is a required document that gets reported to the regulators, but that's required to give to investors. And that gives a sort of full end-to-end rundown for investors of the company, including the terms of the deal, what you're getting, details about the company's operating model and business plan, but also an entire outline of all the risks associated with the investment. So that's a really important document to review and look at to make sure you get a holistic picture of the investment. I would very much recommend that investors review that as well. But all of those documents related to the campaign are all on the campaign page, presented easily for investors to see. Investors can also, go and do some direct research on the company themselves. So you could go to the company website, you could look at the company's social media to try to get some more information. But everything that you should need to make an investment decision should be on the campaign page available for you there.
Great. I really appreciate you taking the time today, answering all the questions. Where can people go to find out more or contact you and learn more about Equivesto and, either raise money or invest in startups on your platform?
Thanks, Craig. Yeah, it's been great being here. You can go to equivesto.com, Equivesto, to learn more about us. We also have an entire learning center, equivesto.com/learn, for both investors and issuers that outlines, the entire process and pretty much every question that you might need to get answered about working with us. You can reach out to me on LinkedIn, and you can follow Equivesto on all the social medias at Equivesto to see sort of what's up and what's going on. And lastly, but not least, if you're interested in sort of seeing what new companies are coming up, but you don't want to do the full sign up, you can go to our website and actually join our newsletter at the bottom of the page. And that'll just come out every 2 weeks and say, hey, here are the companies on Equivesto currently.
Fantastic. Thanks, everyone, for being here and all the great questions. Thanks again for taking the time today, Alex, and we'll talk to everybody soon.
Thanks, Craig. Yeah, thanks.